Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here on Friday, the 29th of May, 2020. Yes, my name is Klatt, and I'll be the moderator here for the upcoming something like 45 minutes on a very, very interesting topic today. Carry trades or trading yield differentials and FX. In fact, it's a very, very fascinating topic, and some of you might have wondered what was so different, let's say some decades ago, I think we have to say, when reading books like, for example, Market Wizards from Schwager, and the sometimes fantastic returns some hedge fund managers posted here over time span of nearly a decade of years, and really having returns north of 100%. In fact, some of you might have wondered what changed during the last years here and why the hedge fund industry is so under pressure right now. And carry trades, respectively, your yield differentials play a crucial role here. And why this is also topic here of the upcoming 40 minutes. So let's probably start. First of all, have a look here at the agenda. These are the topics we want to cover here. So first of all, we want to give a definition on what are carry trades, and what's the target when trading yield differentials, especially. And then also we want to answer the question, how do carry trades and FX work? And what are the risks of carry trades, in fact? And also, I want to introduce to you to a very helpful tool you can find on the website from Admiral Markets. It's the so-called Trading Calculator, and there you get displayed the swap, the positive but also the negative swap here. I want to introduce you to that. It's available for everyone. Then probably, first of all, let's have a look here. This is me. So in regards to my person, I'd like to not go into so many details. I'm not sure whether it's so interesting to talk about me. Some probably consider it to be interesting, because it's always interesting to hear where someone comes from and how you get started in the financial industry, especially in the trading industry. I started as a bank employee, in fact, and found my way after working through nearly every division of the retail banking department. That's the word. Department of the bank I was a trainee, in fact, with, and I was sure that wealth management, asset management, trading in general is the place to be for me, in fact. And this is how I got started. In fact, after that, I started working as a trading assistant for a big stockbroker here. So on the professional side, if you want, and then took it from there. Studied beside my work as a trading assistant here in the professional market making industry. Was a student, and I studied mathematics. And after I saw that it's difficult to bring this full-time job together with my studies, and I wanted to finish my studies. In fact, I went out myself and started trading on my own account, respectively. In addition to that, that was during the poker boom. Some of you probably know the so-called moneymaker boom. That was when a small guy from somewhere in the US won the World Series of Poker, in fact. And there's a parallel between trading and poker. In fact, there's many parallels, and that's how I finance my studies. So with trading, with playing poker, online poker, and at the end, I made my way into the trading industry, in fact. But I gave an interview on that with Admiral Markets, so probably I talked a little too much right now about my person here. And what's interesting here is that here you can see within this interview where I come from, and what is my goal, what's my trading approach, and everything. What's probably most interesting, and this is where Admiral comes into play, is I'm located in Berlin, in Germany, and Admiral has an office in Germany and in Berlin, in fact. So I know the German staff here. A global broker, global financial provider in the CFD FX industry for nearly 20 years now, 19 years of reliability, and with offices in over 20 countries around the globe, in fact. Why is this noteworthy? Besides great commissions and great trading conditions you find at Admiral Markets. And I know that because I trade my account with Admiral too, by the way. There's also a project I run. In fact, there's one other very important aspect, because when it comes to financials, or when it comes to financial services in general, you'd like probably to talk to someone in your native language. And this is exactly where this is great to have a broker which is available around the globe, with offices around the globe, because it's very likely that you will find someone speaking your language, in fact, and you can talk to in your native language. I think this is a big plus, in fact, and it's adding a lot of trust and in the business relationship between a trader and the broker she is trading with, in fact. So yeah, that's it on me, respectively, Admiral Markets. And let's start now with today's topic on the definition. What are carry trades? And carry trades are, in fact, one of the oldest forms of trading strategies, first developed by capitalized. It was more like they traded it and they tried to capitalize on that by elite money managers, for example, like Bruce Conner. I have a picture from Bruce, by the way, that will appear here after. Let's do it right here. So this is Bruce Conner, in fact. And he's one of the guys which was interviewed by Schwager in his book, and is also very, very and highly successful, in fact, since the 1970s, in fact. Self-made billionaire trading the markets. And what he did was that he was trading mainly FX. So most of the time he's it's a global macro guy. Let's say, probably that's a better way to put it. And it was not only FX he traded, but there was a time when he was very, very active, and also not just active, but also very big in the FX trading world. So which has a lot about the volume he traded, because just imagine that right now the average daily trading volume in FX markets every day is between 5 to 6 trillion US dollar. So which means if you're recognized in the FX markets, I mean, back then in the 1970s, 1980s, probably market volume was a little lower than it's today, but still, if you're recognized as one of the biggest guys in this universe, then you're definitely trading huge amounts of money, which points out that this is really someone you want to listen to if you get the chance to, which is very not that common, in fact, because he's as far as I know, someone who is a really more private guy, let's say, or someone who is not really enjoying the spotlights, in fact, of journalism, respectively, of the world in general. But so what he did was, in fact, that he traded FX, and what he did was that he traded two currencies against each other. And here trying to participate from a different yield differential, in fact. So what the trader, in fact, does when looking for a carry trade is that he borrows, respectively, he sells the currency with the lower yield and buys the one with the higher yield, and pocketing the yield differential as a profit, in fact, beside potential gains out of the bought currency rising against its counterpart. It was a classic trade, probably we can call this, which was also highly and actively traded right before the great financial crisis. So probably you have wondered what happened there in, for example, currency pairs like Australian dollar JPY. So if you have a chart which has enough historical data, just go on a monthly chart and zoom out of the chart, zoom out of the chart, and you will see that 2007, 2008, for example, Australian dollar JPY saw a big drop, in fact. And that was mainly due to the fact that these carry trades saw a big unwinding, in fact, or as a result out of the deleveraging taking place there. What you usually hear is, and that's most of the time, it's probably, not sure whether it's true or not, but I think it's too easy, and it's also different to understand. In fact, difficult to understand when you look at JPY, for example. So when there is risk off hitting the markets and there's deleveraging taking place and markets start to panic, or at least there's some larger drop in equities, for example, and you see a spike higher in volatility, what you usually see is then that the JPY sees stronger demand, where, for example, higher yield currencies like Australian dollar or New Zealand dollar are sold, in fact. And it's not uncommon that you hear someone saying then, well, the reason for that is because it's the JPY is a safe haven currency. Why is this difficult? Well, look at the debt to GDP ratio, in fact, in Japan, for example, and you're seeing a number which is, I think, north of 200% right now. It's even higher than when you look at Greece. There's a big difference between Greece and between Japan, in fact, because Japan's debt is mainly domestic, so it's mostly located in Japan, let's say. But still, it's a quite high number. And looking at a currency with such a high GDP to debt ratio and calling it a safe haven currency is difficult to argue from a fundamental perspective. So what's happening there then? Why is the JPY usually strong in a risk-off market environment when deleveraging is taking place? Well, this is because of the unwinding of carry trades, because market participants in such a high risk environment, or risk off, let's call it risk off environment, they are not looking for yield and trying to profit here, in this case from a yield differential, but they are going back into liquidity, respectively into classic safe havens, which is naturally then resulting in an unwinding of carry trades, which once you buy here a high yield currency and finance it with JPY, which means that you have to buy back JPY in this market environment then, which means that JPY usually rises in a deleveraging market environment. It's also one of the reasons, for example, why gold is rising, because once you see here risk off hitting, what market participants do is they are going for, in case of bonds, for example, they're going for highly liquid assets and very actively traded assets like US bonds, for example, which naturally results in the price of bonds rising while the yields drop. There's an inverse correlation. So now the thing is that once yields drop, then gold becomes more attractive, because gold is, let's call it yieldless, in fact. So what you get to see then is that in a risk-off market environment, there's a natural demand in gold, or towards gold, and market participants are demanding gold, in fact, because of the fact that it's becoming more attractive to keep gold in your portfolio because of yields dropping, in fact. So just to give you an idea what's happening there. So now, the thing is, let's come back to carry trades here, and JPY especially as a perfect example for that. It's not necessarily because the JPY is a safe haven currency, but it's more likely that the JPY as a nearly zero yield currency, in fact, is demanded due to the fact that these carry trades are unwinded. So that's one of the main reasons, main drivers why in risk-off deleveraging market environments you see a natural demand for JPY, respectively, once risk-off kicks in and market participants are looking for yield and looking for performance, in fact, then you see naturally JPY being sold. It's like you borrow a JPY and then you buy the higher yield market in case of US dollar, for example, or New Zealand dollar, Australian dollar. The thing is, it would have probably been better to have this webinar something like a year ago or something, because right now there is no such thing as a yield differential. I'm not sure. I read yesterday that I think over 100 central banks, I'm not sure about the concrete number, but have cut yields or cut rates due to the Corona lockdown and everything. So carry trades right now are not the place to be, because the yield differential is nearly non-existent anymore. But this is something we will look at a little later on. So now let's have a look here at a simple example, a very easy example to understand a carry trade. In fact, what you do is you borrow, for example, £5,000 sterling from your bank, and you're charged a lending fee for these 5,000 of 1%. And if you now buy with these 5,000 pounds sterling, you buy a bond which yields 4%. Well, the profit is the yield differential, in fact, of 3%. It's a gross, so without tax and everything, because you have 4% of the bond, which yields 4%, and you have to pay the bank 1%. The difference is 4 minus 1 is 3%. And this is a classic carry trade, in fact. It's also one of the reasons I was personal example, for example. So if you're a trader and if you know about this carry trade, then it's not uncommon that you from time to time, when going shopping with your wife, you think in terms of a trader. So, and I remember there was there was an occasion when we bought, I'm not sure, was it a sofa, so a couch, a place to sit on, I think, and it was like 2,000 or so, 2,000 euros. And then they came to me and I said, well, you want to finance it? And I looked at him and said, well, not sure. I can also pay in cash for it. So it's no big deal. And then they said, yeah, it's a zero yield financing program. So you buy, right? You take now the couch with you, but you pay, let's say, 200 euros for 10 months, and you don't have to pay one dime extra. And I was like, this is great, because then I can save, let's say I start today and I still have 1,800 left, and I can, for example, trade with it and try to extract some value out of the market, and then I have a positive return on this. It's a carry trade. It's a classic carry trade. In fact, that's just a personal anecdote here in this context, how you can imagine a carry trade in the real world. So this is the real world. Let's have a look now on how carry trades look in the FX world, in fact. And as I already said, an FX carry trade involves two currencies with different yields, and this difference is called the yield differential. Differential because you take the difference between these two yields, in fact. And what the trader does, it borrows, respectively sells the currency with the lower yield, buys the one with a higher yield, pockets the yield differential as profit, and potentially also the gains out of the bought currency rising against its counterpart. It's also something which is, yeah, in the right now in the world, it's completely different how this looks like. By the way, let me just probably give you a short list here on countries with different yields. In fact, this is quite active, in fact, or actual. So Switzerland is very negative. So what they try to do is keep their Swiss franc, the Swissy, as unattractive as possible, because they don't want to see their currency appreciate against their counterparts, especially against the euro, due to negative effects this has on their export, and thus on their economy. Japan is slightly negative. EU is 0, so there's no yield at all after the massive quantitative easing, which also kicked in now after the Corona lockdown with the PEP. The ECB announced and everything. It's also not uncommon to see, for example, German yields up to 30 years to pay negative yield, or pay, well, you have to pay. In fact, if you buy a bond, a German bond here of, let's say, 10-year duration. And there's also high yields countries, which are emerging countries, obviously, so Brazil, but also Turkey. The question you might have here is it worth it? So why is yield? It's usually it's a tool to measure the risk you face once you buy a bond in the respective currency. So Brazilian real or Turkish lira, for example. So the thing is, do you really get your money back, let's say, when looking at the very fragile political environment in Brazil, also in Turkey, for example, when you look at the big swings from time to time, you see in the respective currency, Brazilian real, also Turkish lira, due to political instabilities, due to the economic developments, due to rising fears that these countries probably might default on their debt, like Argentina, for example. This is why you see usually these countries with a higher yield. Well, let's say 5, 6, 10 years ago, you probably, or we would have not included Brazil here or Turkey, but worked with countries like New Zealand or Australia, for example, which also yielded significantly higher than US or European bonds, in fact. And what's the reason for that? Well, it's simple. You have, or you still have, but the environment completely changed. But these high yields currencies in G7 countries or G7 currencies, they're very dependent on commodities and the commodity environment, in fact. And usually what you have in these countries is a higher inflation expectation. And you counter that to try to avoid, especially, the economy to overheat. You try to avoid this as a central bank by rising rate, or by hiking rates. In fact, this is what you do. So what you naturally see is in these countries that there is a higher inflation expectation, which means a higher yield. Now the thing is, if you see the inflation expectation completely dropping, collapsing, as we do right now due to the developments around the corona lockdown, economies shutting down, well, the thing is that then these countries have to counter these counterproductive developments in terms of inflation and cutting rates, in fact. So what means, and now we come back here to the potential gains, and that's why I'm mentioning this. The thing is, if you see a currency like the Australian dollar, for example, see capital inflows due to rising economic expectations among market participants, due to the fact that we say, well, the biggest economic partner is China, due to the demand in China for, let's say, iron ore. So, or to put it more generally, hard commodities. Well, then you naturally see the economic expectation, and here the keyword is exports. You see the economic expectation to rise hand in hand with the rising economic expectation when it comes to China. And if you see these capital inflows and the economy picking up momentum, then usually inflation picks up too. And this is then the moment once a central bank has to counter this and has to say, well, now we have to see that it's not over, that the economy is not overheating, that the inflation is not shooting through the roof. And that's why we try to dampen the money which flows into our economy by making it more expensive by hiking rates, in fact. And thus you see not only rates which rise, or yields which rise, but you also see the currency rising in value due to the capital inflows you naturally see. The same is true on the other hand, certainly. But just to give you an idea why this is mentioned here, because it's in fact crucial. Right now, the market environment is, it's a very, very difficult market environment, and inflation expectation, economic expectations are not justifying massive capital inflows in countries like Australia, for example. Also not only due to the developments in Australia itself, but also and especially in China, for example, and the economy there seeing also, or having taken a big hit due to the corona lockdown, and Wuhan, for example, and so on and so forth. So you can see here that naturally, nevertheless, in a, let's call it, normal market environment, rising yields, and in a market environment in which you see natural developments like capital inflows and inflation expectation picking up, that this naturally not just results in yields to rise, but also in gains you can expect from the respective currency due to an appreciation against its counterpart because of rising inflation expectations, rising economic expectations. By the way, 1 second, please. This is something we will mention in a few seconds. Very interesting question, in fact. I will mention this. Carol is asking, what reason is there for some rates to be in minus territory? I will explain this, but we have to first of all here have a look at the contract specifications. But I will dig into this in a few seconds, so it's not very long. Just yeah, probably 3-4 minutes. So now the question, where do I find information about swaps? So first of all, you can view the swap charges in the Admiral Markets contract specifications. This is what you find on the website. So here you have, okay, perfect. There you have the example, Euro USD, for example. There you can see the swap value for long positions, respectively. You can see the swap value for short positions. And once there's a 3-day swap, but we will dig into this in a few seconds. It's Wednesday usually. So the swap value is the amount to be credited or debited for rolling a buy-sell position over one trading day into the next. So what does this mean? Well, once I took this screenshot, there was a yield differential which was big enough that once you held a USD long position or Euro USD short position, it means nothing more than you bought here the US dollar with borrowed euros, in fact, once you're shorting the Euro USD, which means once you're selling the euro, you're charged with 0, while you buy the higher yielding US dollar, which you get credited to your account. And the difference between those two then is a classic carry trade. Has been, let's put it that way. And that's why you can see here the value for the short position to be positive, while the swap value for a long position is negative, and it's massively negative, in fact. Why? Well, because once I took the screenshot, there was a bigger yield differential. It's not just that the euro yielded 0, and this for quite a while right now, but the US dollar 4 months ago yielded over 2%, in fact, which means once you borrow for 2% US dollar and then you're buying with the borrowed US dollars euro, you have to pay the difference, in fact. And that's why for a long position, you see here a big minus, in fact. So this is, first of all, how it's possible that you're seeing a minus here. We will see, by the way, in a few seconds in the trading calculator, you will see that now there's a minus for long but also short positions, even though, let's go back here, even though you see a slight positive sign here when it comes to the US dollar. And this has to do with the way our brokers calculate the swap. Because what you usually do is you add, respectively subtract, depending on which direction you take it from, the so-called LIBOR rate. So this is the London Interbank Offered Rate. A London Interbank Offered Rate is the yield banks charge each other for what's the word for this? For lending money to each other overnight, in fact. So, and since we might wonder, okay, why can't we just just skip this step and just leave the LIBOR and just work with the yield differential? That has to do with the fact that we are here in FX trading and retail trading. We're working with leverage, and if we are holding, let's say, a position of 100,000 euro USD overnight, even a short position here, which means we are short 1 lot euro USD, that means that we do not have to put up 100,000 to hold the position, but we are leveraged. And once we work, let's say with the leverage, classic retail client leverage of 30-1, let me just here calculate this. It's 100,000 and you have to divide it by 30. So you only have to put up 3,333.33 euro to hold this position if you're leveraged 30-1. So the rest of the position is then added, let's say, from the broker. So it's quite expensive for a broker to help you to roll a position overnight, and that's why the LIBOR is put on top of that to make just sure that the broker can help you, respectively can offer you this service of rolling one lot Euro USD short in this context overnight here, and can keep the position for you overnight with the liquidity provider. So just to give you an idea on that. So, and now the 3-day swap, why is there's a 3-day swap? That's something you will see naturally happening once you have a position from Wednesday till Thursday. There's a 3-day swap because there's no trading taking place over the weekend. So Saturday, Sunday, even though the FX market is a 24-hour market, 24/5, it's closed over the weekend, and there's no swap charged, in fact, respectively credited, which means that here on a Wednesday, then there is not just the swap, which is credited / debited from your account or to your account once for Wednesday, but it's also Saturday and Sunday on top of that. And that's why you have a 3-day swap here every Wednesday. And this is quite common. So there's, as far as I know, there's no broker out there doing it differently, in fact. So now let's have a look here at the risk of carry trades and go through this here. And after that, I will introduce to you then the Admiral Markets Trading Calculator, where you can see it yourself, play around a little and see the yield differentials yourself quite quickly, quite directly. So low yields usually point to economic difficulties, with a central bank holding the interest level low to encourage consumers and also businesses to borrow, spend, and invest to increase economic activity. So look at the current yields levels, current rates of central banks, and you will see, well, obviously, thanks to the Corona lockdown, there's lots of economic difficulties, and not just only that. That's always, yeah, it's very funny. I have to say that. I mean, probably you followed Donald Trump on Twitter. Right now, the question is how long you can follow him on Twitter. If he continues to behave the way he does, or probably they will shut his account down, but that's just a personal opinion. I just wonder, what is he talking about? When looking at European countries, for example, the ECB, and pointing to negative yields, and then going, berserk nearly, and attacking the Fed, that he wants the Fed to turn negative too, and so give negative yields. So once an economy has to charge someone to lend money to you, which doesn't make sense from an economic perspective at all, from a rational perspective. I mean, if I give you 100,000 euro, I expect you to give me 100,000 euro plus a yield on top of that for the risk that you're defaulting on the debt you have with me in this case. So why should I give you 100,000 and you only give me back 99,000 and the deal is done? I mean, from a pure rational perspective, that doesn't make sense. It only makes sense if the economy is so bad that here in this case, central bank has to really do everything possible to make sure that banks, or especially consumers here, or customers from banks, don't want to put their money in a bank account because they have to pay for this, but instead that they have to take it out and consume, and that they spend the money. So the economy has to be in terrible shape once you go negative with yields. And this is what makes you smile. Once you know that, I mean, why is a US president wishing for negative yields? He's wishing for that because he obviously doesn't understand why a central bank goes negative, in fact. There's lots of trouble with the economy. And then if you go on, let's say, CNBC and tell the people there how great the US economy is doing, but you want negative rates, that just doesn't play out, right? So that doesn't make sense at all. And this is something you have to remember when it comes to carry trades in general. So low yields is usually a sign that the economy is facing enormous trouble, in fact. And that's that. With an economy bottoming out, for example, starting to grow again, even though I could imagine this to take some time in our world after the Corona lockdown. But let's imagine you're borrowing a low yield currency like the JPY, and you're buying a high yield currency like the Australian dollar. Well, what happens then is once the Japanese economy starts to grow and yield expectations start to rise, and probably the central bank has to hike rates. That's very unlikely since we are nearly in a zero yield environment in Japan now for nearly 30 years. But still, just imagine that, or let's assume it's possible. That means that hiking rates here may negatively affect our carry trade, which means we will naturally see that there will be a natural appreciation in the currency we shorted, in fact, because of the fact that the economy is bottoming out and start naturally to rise due to inflation expectation rising and everything like that. So this is definitely a risk when it comes to carry trades. And also here, profiting from a yield differential is one thing, but profits here could be offset due to a negative price development in the underlying currency trade, the FX traded trades, the so-called delta risk. So I just presented to you a few minutes ago what naturally happens. So the basic idea behind the carry trade, and why it's not only the yield differential, which might work in your direction and the positive yield in your trade, but also a potential appreciation of the currency you're buying here due to a natural positive economic outlook. The thing is, it could also play out the other way around. So, for example, you're holding a currency which has a high yield, let's say Brazilian real, for example, and you say, I buy this currency, but then you're financing in, let's say, US dollar, and then you have something like the Corona lockdown, which will naturally affect emerging currencies in a negative way, because these countries are known to not be politically stable, the economy to depend on a global environment, the overall global environment, demand from countries like China, for example. You will see naturally capital outflows, even though you have a higher yield, but the higher yield results out of the fact that market participants are skeptical in regards to the long-term expectation to this country, to the currency. Respectively, they are also very skeptical when it comes to where it's not just skepticism, but it's more like the price such a country has to pay for being, let's say, an emerging country, for example. So, and with this in mind, it could be that the delta risk is offsetting here, or the delta risk exists, and the negative developments in the currency value itself you bought may be offsetting the yields you get for holding a position. So, and now to simulate a trade, you can check out here the Admiral Markets Trading Calculator. And this is how it looks like. But let me just, I think that makes more sense now to guide you through this on the website. So I prepared it already here. Let me just go here. So this is the website, admiralmarkets.com, and I opened it already. But you can go to admiralmarkets.com, and then you go here to the Start Trading tab. You only go with your mouse on it, and there you have the trading calculator. If you click on this, this is the website which opens. And now what you can do is you can here enter the instrument. Let's work with EURUSD in this context. And here you can enter the position size you plan to take. Let's say it's 0.1, it's 1 microlot. Here you have the leverage. So this is a professional leverage. We can also go to the retail leverage here. In this case, it's 30-1. You have the account currency, let's say it's euro, and then you have the opening price. Let's assume it's 110, and you plan to close the position. Let's put here the closing price, the stop level, probably, which is of interest for you. So it's 0870, let's say. And then you buy Euro USD. That's, by the way, why I say that. It's very simple, because we just saw a breakout out of the trading range, and you see probably the gaining momentum here. Once you check the TAP analytics and there the traders block, you can see that the breakout, which occurred yesterday or the day before, already on Wednesday. I think it was yesterday. Yeah, the dynamic breakout was yesterday. We already mentioned it in our one research piece here in the traders block section last Tuesday, in fact, so 3 days ago, and yesterday the breakout finally occurred, and the opening price was 110, while the stop of the position was 108.70, and we're still going, by the way. So the target is around 112, 112.50, but just to give you an idea where the numbers now come from. And now we can click on calculate, and what happens is that you see here contract size, it's 10,000, it's 1 mini lot. And there you have the pip value now. The pip value is 90 cent per 90 euro cent in this case, so per pip. And there you can see it here, the swap short and the swap long. The margin 333, but our focus now here, this is, by the way, the risk, the profit. It's not a profit, but it's the risk you're taking when you enter the position at 110 with a stop at 108.70, and then here with a mini lot, by the way. But we want to focus here on a swap short, swap long, and you can see what I already mentioned. You have two negative numbers here, and this is due to this LIBOR, which is added on top, respectively subtracted. In fact, even though there's a slight, which is it's diminishing, let's say. So I could imagine, for example, US yields to keep on dropping, which continues to diminish this yield differential, adding further bullish momentum to the euro then in this case when it comes to the US dollar. But here you can see the swap and a swap short, swap long for holding a position 1 day, in fact. And then you see, let's say you hold the trade 5 days, then you have to pay 5 times for your long position, 5 times 55 cents, for example. And that's it, in fact. So nothing real spectacular, but just feel free. I will just enter this here in the chat box. I call this TC for Trading Calculator, okay? And then just, yeah, check it out, play around a little. I think it's self-explaining. And it's a great way to simulate a trade already before, not in a chart, but to see parameters which will affect your P&L, like the swap you have to pay for holding a position overnight, in fact. And now let's go back here to the presentation. So this is a screenshot we took. By the way, it's the same example, only with 120, 120.50, in fact. Well, let's come to the summary. So I'm having a look here, a quick glance at the time, and I think we have to hurry up a little. So let's have a look here at the summary. So first of all, carry trades are one of the oldest forms of trading strategies, first developed, traded by elite money managers like Bruce Conner, for example. An FX carry trade involves two currencies with different yields, a positive and a negative yield. Differential occurs then. The trader borrows, sells the currency with the lower yield and buys the one with a higher yield, pocketing the yield differential as a profit, and beside potential gains out of the bought currency rising against its counterpart, once there is really a positive appreciation of the bought currency then against the sold one or borrowed one. And carry trades currently occur mainly between major and emerging currencies. In emerging currencies like European euro, US dollar, and then traded against, let's say, the Russian ruble, Brazilian real, Turkish lira, for example, due to diminishing yield differentials because of a global recession, which plays a very important role. Still, it's interesting to keep this in mind once, hopefully rather sooner than later, the economy around the globe will bottom out and gain momentum again. Then carry trades will definitely become a big topic again. And yeah, don't forget to join us next time. So on Monday, same time, 2 p.m. London, Paul will be here to tell you something about the Guppy moving averages, including answering the questions, what are Guppy moving averages? How are they displayed on the charts? How to interpret them? And how to trade them or using them in your trading, these Guppy moving averages. And yeah, 2 p.m. London, 1st of June on Monday. check your inbox for the webinar link for all these people right here now, live in the webinar. Then you're registered. If you're watching us on YouTube here, please leave a thumb up here if you enjoyed what you just saw. If you have any questions, feel free to ask them in the chat box. Also, feel free to also ask them in our trading spotlight community. And if you watch this on YouTube, let's come back to this. So then head over to admiralmarkets.com and go via the education at the webinars tab to the registration page for the Trading Spotlight webinar series. And yeah, there you can register. Here's the website. Here's the contact details. And Admiral Markets is a regular broker. We have to put a risk disclaimer at the end. That's it from my end. So all the best. Happy trading. Watch your stops. Enjoy your weekend. Stay safe and talk to you again next week. Then on Friday will be the 5th of June, if I'm not mistaken. That's it from my end. So all the best. Talk to you soon. Bye-bye.